Married or common law? Discover the tax implications. Your marital status plays a significant role in how you file your annual income tax return in Canada. It determines your eligibility for certain tax credits, deductions, and benefits. This guide will explain the marital statuses recognized by the Canada Revenue Agency, CRA, how they impact your tax filing, and the crucial factors to consider when choosing your status. Marital status options. The CRA recognizes the following marital statuses for income tax purposes. Married. You are considered married if you were legally married on December 31st of the tax year. This includes traditional marriages and registered domestic partnerships. Common law partner. You are considered a common law partner if you have been living in a conjugal relationship with your partner for at least 12 continuous months, or if you have a child together, by birth or adoption, and are living together. Living separate and apart. You are considered separated if you were living apart from your spouse or common law partner on December 31st of the tax year due to a breakdown in the relationship, and you did not reconcile before that date. Widowed. You are considered widowed if your spouse or common law partner has passed away and you haven't started a new conjugal relationship. Single. You are single if none of the above situations apply to you. This means you haven't been married and do not have a common law partner. Why does marital status matter? Your marital status impacts several aspects of your tax return, including filing options. Married or common law couples can choose to file their income tax returns jointly or separately. Each option has its potential benefits and drawbacks. Income tax rates. While Canada utilizes a progressive tax system, marital status doesn't directly change the tax brackets or amounts you pay. Tax credits and benefits. Your marital status determines your eligibility for several tax credits and benefits, such as the spouse or common law partner amount, the Canada Caregiver Credit, the GST/HST credit, child benefits, such as the Canada Child Benefit. Income splitting. Married or common law couples may be able to reduce overall taxes paid through pension income splitting on eligible pension income. Choosing your marital status. It's essential to accurately represent your marital status on your tax return. While most situations are straightforward, there are a few considerations. Couples living apart. If you are married or common law but were living separately on December 31st due to a relationship breakdown, you must indicate that you are living separate and apart. Recent relationship changes. If your marital status changed during the tax year, such as marriage, separation, or death of a spouse or common law partner, you'll need to reflect those changes and their relevant dates on your tax return. Common law status. Remember, if you have been living with your partner in a conjugal relationship for at least 12 continuous months, you're considered common law by the CRA, even if you do not view your relationship in those terms. Married versus common law. Tax implications. For tax purposes, married and common law couples are treated largely the same. Here's a breakdown of some key areas. Joint filing. Both married and common law couples can choose to file a single tax return together. This can simplify the filing process and potentially lead to tax advantages. Transferring credits. Certain tax credits, like the spouse or common law partner amount and the amount for an eligible dependent, can be transferred between partners if one person doesn't need to use the full credit amount. Income splitting. Both married and common law couples have the option of potentially reducing their overall tax bill by splitting eligible pension income. Key considerations for specific marital statuses. Single. Single filers may be eligible for specific tax credits like the amount for an eligible dependent if they are a single parent. Separated. Separated individuals will file their tax returns separately. Certain tax credits might be claimed by either spouse based on specific circumstances. Widowed. Widowed individuals may be eligible for additional tax credits and benefits.